So join us now for some market reaction and analysis. Sarah Malik, Chief Investment Officer for Nuveen's $420 billion global equity division, and Sarat Sethi, Managing Partner and Portfolio Manager at DCLA. He's also a CNBC contributor. So, Sarah, you got that 420 split right down the middle. AMC, GameStop, and then cryptocurrencies. Is that where you're with a few NFTs thrown in? Maybe that's not where you're playing right now.
A third, and some SPACs. Actually, today's payroll report is just another piece in the puzzle of where we are in the economic cycle. And our view is that it eases the pressure on the three key factors that are impacting the markets right now. That's inflation, taper talk, and peak earnings growth. We're in the transitory camp when it comes to inflation. With taper talk, we think that today's number actually keeps us further away from where the targets for pricing and also employment. And then speaking of our portfolios, what are we talking to our clients about? Peak earnings growth likely happens in the second quarter. Our view is own those companies that have a lot of macro tailwinds in sectors such as industrials and financials, but also have the support of strong balance sheets and returning cash to shareholders. So these are dividend growers. So you can basically play offense while also getting defense in your portfolio.
So you indirectly answered, I guess, what I was getting at, and that is that these other things can occur separate and discrete from how you look at the overall stock market in terms of valuation and speculation, and whether the Fed is influencing, price earnings multiples by keeping rates low. You can deal with all that and still stay long based on some of the things you just said.
Yeah, if you look at the individual investor, they're here to stay. Their options data right now, they're as active as they were in January, but these are pockets of bubbles. They will have impact, perhaps on smaller investment managers. You saw that in January. I think for larger firms, though, like ours, it's an advantage. We use this type of volatility as an opportunity to step in and provide liquidity on the other side when, maybe it's not GameStop, but some of these bigger companies that become cheap if some of these other asset managers get impacted because of the individual investor and what they're doing.
Sarat, you're still dancing selectively?
I am still dancing selectively, and I think this number was more of a Goldilocks number because you do have the Fed staying back, potentially talking about taper, but it'll all be more even. And I think at the same point, you do have sectors and stocks that are going to do well, such as the financials, select industrials, and healthcare is going to come back too as we get more hiring. What I also think is interesting is this also, and I agree with Sarah, gives us the opportunity to buy select technology stocks. You saw that yesterday when there was a foreboding of, maybe a really strong number today. And, companies like a Google or a Facebook that are big cap, large, trading at what we think are good valuations, the market gives us opportunity to dip in. So I think you stay the course. If you've got cash on the sideline, you can buy good companies. And when the inevitable dips come, you buy even better companies at a much cheaper price.
So reopening is going well, obviously, Sarat, rebounding well, even though the jobs numbers are, for whatever reason, are a little disappointing. But you think this gives equities a tailwind for how long, Sarat?
I think for the next 3 to 6 months, Joe, there's an interesting point here. It's because of all the money coming in from all the states, you're going to see an uneven jobs report. But the biggest thing is to watch is credit spreads. And I think when the Fed does that, that's what we're going to watch.
Shepard Smith here. Thanks for watching CNBC on YouTube.